Donald Trump is the new president of the United States.
Donald Trump has been elected president, defeating Vice President Kamala Harris.
But what can we expect from the stock market now? Is this the right time to buy new stocks? Donald Trump has won the election, and the market is about to react.
This will truly be the golden age of America. That's what we have to have.
For big investors, the leadership transition brings unique opportunities, but also great risks. Keep up with me in this video to learn the best stocks to consider buying with Trump back in the White House, and which ones you should avoid right away. Let's get straight to the point to identify profitable opportunities and how to protect your portfolio. With so many questions surrounding Trump's policies and how they'll shape industries, it's crucial to understand which companies stand to benefit and which could face challenges. Think of sectors like energy, tech, and infrastructure. Some will likely soar under Trump's policies, while others might struggle to keep pace. So, let's get started by setting the stage with the economic and political context driving these changes. To understand which stocks might benefit most or struggle the hardest under Trump's renewed leadership, we need to start with the political and economic landscape that a Trump administration would likely create. In his previous term, Trump introduced policies aimed at reducing regulations, particularly in sectors like energy and finance, which provided a boost to certain industries while tightening the screws on others. A second Trump term is likely to follow a similar path, reinforcing policies that encourage growth in specific sectors while potentially introducing new regulations that could impact others. One key policy area to watch is Trump's stance on energy independence. His administration previously championed traditional energy sources, such as oil and gas, by rolling back environmental restrictions and supporting domestic production. This approach created growth opportunities for companies in the fossil fuel sector, which could again see favorable conditions. On the flip side, renewable energy companies, which had been gaining traction, might face more hurdles as the administration shifts focus back to traditional energy sources. This policy direction is essential to keep in mind, as it will influence stock performance and investor confidence in these industries. Infrastructure investment is another area to watch closely. Trump has historically advocated for significant spending on infrastructure, aiming to boost the American economy through large-scale projects. Should he push forward with such initiatives, industries related to construction, materials, and heavy machinery could see a positive ripple effect, boosting the prospects of companies within these sectors. Trade policy is another influential factor. Trump has taken a firm stance on America First, emphasizing trade agreements that favor U.S. interests and penalizing companies that outsource jobs or rely heavily on foreign production. His policies led to increased tariffs on imports from several countries, including China. If he maintains or intensifies these policies, it could impact companies with significant global operations or those heavily dependent on imports, particularly in sectors like electronics and consumer goods. Understanding which companies could suffer under these tariffs is critical to protecting your investments. Now that we've laid out the political and economic landscape, let's dive into specific sectors and stocks that are positioned to benefit most from Trump's policies. Here, we'll look at 3 sectors likely to thrive: energy, infrastructure, and technology. For each sector, we'll pinpoint particular companies that could see gains under Trump's influence. But first, it's worth remembering that this is just my opinion, so don't base your decisions on it alone. If you disagree, feel free to give your opinion here in the comments. Energy sector, oil and gas resurgence. Trump has historically supported the fossil fuel industry by easing regulations and encouraging domestic production. With a renewed push for energy independence, companies within this sector could see favorable conditions that translate into higher stock prices. For example, ExxonMobil and Chevron, 2 giants in the oil and gas industry, stand to gain from increased production and relaxed environmental regulations. These companies benefit directly from policies that reduce operational costs and increase demand for domestic energy sources. Additionally, smaller players like ConocoPhillips may also see an uptick in value as production ramps up. If Trump continues to prioritize traditional energy, these stocks are likely to experience growth in the short to medium term. Investors looking for more stability could consider ETFs like XLE, which track a broader range of companies in the energy sector and help mitigate individual stock risks. Infrastructure sector growth through domestic investment. Another sector with substantial potential under a Trump administration is infrastructure. Trump has repeatedly emphasized the need to rebuild American infrastructure, from highways to bridges to digital networks. Such large-scale projects would drive demand for materials, construction equipment, and engineering services. Key players here include Caterpillar Inc. and United Rentals, both of which provide heavy machinery and equipment used in infrastructure projects. Caterpillar, for example, has a history of benefiting from increased government spending on infrastructure, while United Rentals offers a range of equipment crucial for construction and industrial operations. Beyond machinery, companies supplying materials like Vulcan Materials and Martin Marietta Materials may also experience gains. If Trump follows through on his infrastructure goals, demand for these materials could surge, driving up stock values in this sector. Technology sector, domestic tech advancement. While technology may not be the first sector that comes to mind under Trump's administration, there are specific areas within tech that could benefit, especially companies that support domestic advancements or have limited exposure to foreign markets. Qualcomm, for instance, stands out due to its role in telecommunications and 5G technology, areas that are likely to receive support as the US aims to stay competitive in tech. Similarly, Cisco Systems could benefit from policies that prioritize American-made technologies for infrastructure upgrades, particularly in digital and telecommunications infrastructure. In addition, companies focused on cybersecurity may also see an uptick, given Trump's emphasis on national security. CrowdStrike and Palantir, both of which specialize in cybersecurity and data analytics, could become increasingly important as the US aims to protect its digital infrastructure from foreign threats. Now, while some sectors stand to benefit from Trump's policies, others may face significant headwinds. Here, we'll focus on sectors like renewable energy, international tech, and consumer goods heavily dependent on foreign imports, all of which might see negative impacts under Trump's leadership. Renewable energy sector facing regulatory setbacks. Under a Trump administration, the renewable energy sector may face increased obstacles, as his focus has traditionally been on bolstering fossil fuels and scaling back environmental regulations. Companies like NextEra Energy, a major player in wind and solar power, may experience slower growth as policy shifts favor oil, gas, and coal over renewable initiatives. Similarly, First Solar, a leader in solar technology, could face reduced government incentives and subsidies, making it harder to compete with traditional energy companies. For investors in renewable energy, the long-term growth potential of clean energy remains solid, but Trump's policies may present short-term challenges. Those heavily invested in this sector might consider rebalancing until there is more policy clarity. International tech companies. Trade policy under Trump has been marked by tariffs and trade barriers, especially against countries like China. This could negatively impact US tech companies with significant foreign operations or dependencies on imported components. Apple, for example, relies heavily on Chinese manufacturing and could see profit margins squeezed if tariffs increase. Nvidia, another tech giant with a global supply chain, may also face increased costs and potential trade obstacles. Investors with a tech-heavy portfolio should pay close attention to companies that depend on international supply chains, as they could encounter additional costs and production delays. Finally, consumer goods companies that rely on imported materials or products are at risk. Nike, which outsources much of its production to Asia, may face higher costs due to import tariffs, which could affect profitability. Similarly, Walmart, a major retailer that sources products from overseas, might see reduced margins if trade restrictions increase. By identifying stocks that could be vulnerable under Trump's policies, you can make more strategic choices in your portfolio. In times of political change, managing risk becomes crucial for investors. With Trump's policies creating a mix of opportunities and challenges, a diversified, well-protected portfolio is essential. The first step in protecting your portfolio is to diversify across various sectors. While it might be tempting to focus solely on industries that could benefit under Trump, such as energy or infrastructure, spreading your investments across other stable sectors like healthcare, utilities, and consumer staples can provide a cushion during volatile periods. These sectors tend to be less sensitive to policy changes and can help balance losses in other areas. For example, Johnson & Johnson in healthcare and Procter & Gamble in consumer goods are known for their stability and can add resilience to your portfolio. Consider defensive stocks and ETFs. Defensive stocks, those less affected by economic cycles, like companies providing essential goods and services, can be effective in reducing risk. Look for stocks in sectors that maintain demand regardless of political or economic conditions, such as utilities or essential retail. Another protective strategy is to invest in dividend-paying stocks. Companies with a history of paying dividends, even during economic downturns, provide a source of steady income and tend to attract long-term investors, making them less volatile. Coca-Cola and AT&T, for example, are known for consistent dividends and can add a level of stability and cash flow to your portfolio. Dividends also allow you to reinvest returns, further growing your investment over time. Remember, staying flexible and monitoring economic updates will give you an edge in adjusting your investments as conditions change. Do you think this market prediction is right? And which stocks do you think will thrive or struggle with Trump? Tell me in the comments and I'll read them all. If this video helped you, subscribe to the channel to give back. See you next time. Good investments.